Hello everyone, and welcome back. If you've been scrolling through real estate apps lately, you look at the prices in the suburbs where you actually want to live, where your friends are, where the good cafes are, where your job is, and you feel that knot in your stomach. It feels impossible. But what if I told you that the impossible is only impossible if you play by the old rules? What if the key to wealth wasn't buying the house you sleep in, but buying the house that makes you money? Today, we're doing a deep dive into the strategy that has moved from the fringes to the mainstream. We're talking about rentvesting. Now, I know what you're thinking. Rentvesting? That buzzword has been around for a decade. You're right. But here is the kicker. In 2026, it is no longer just a clever hack for the savvy few. It has become a survival mechanism and a massive opportunity for the many. We're going to look at the hard data, the numbers that Westpac, the ABS, and the RBA are releasing right now. We're going to talk about why Sydney and Melbourne are pricing people out, why Brisbane and Adelaide are still fascinating, and most importantly, how you can actually pull this off without going broke. Let's dismantle the old way of thinking. Part 1. The harsh reality of 2026. Let's start with the elephant in the room, affordability. If you are a young professional in Australia right now, you're facing a landscape that your parents literally cannot comprehend. Let's look at the scoreboard. As we sit here in 2026, Sydney's median house price is knocking on the door of $1.5 million. And if you look at the projections, it's not stopping there. We are projected to hit $1.83 million by the middle of this year. That is a staggering number. Melbourne isn't exactly a bargain bin either. It's hovering around $978,000 and creeping steadily toward that $1.1 million mark. For the average first-time buyer, traditional homeownership, the idea of buying a nice house with a backyard within 30 minutes of the CBD feels increasingly out of reach. It's not just a stretch. For many, it's a fantasy. And this is where the market is shifting. We are seeing a fundamental transformation in how wealth is built. The buy where you live model is breaking down under the weight of these prices. When you have industry veterans using language like that, you know we are in uncharted waters. We are dealing with limited supply, building costs that have absolutely inflated over the last few years, and fierce competition from seasoned investors who have deeper pockets than you do. So if the front door is locked, do we just give up? No, we climb in through the window. Part 2. The rentvesting solution. Enter rentvesting. For those of you new to the concept, let's strip it back. Rentvesting is a property investment strategy where you rent a property in the location where you want to live, keeping your lifestyle, your short commute, your proximity to the beach or the city, while you purchase an investment property in a more affordable area that you can actually afford. You are separating your lifestyle from your wealth building. Instead of stretching yourself so thin that you're eating instant noodles in a house you own but hate, located 50 kilometers from your friends, you stay where you are. You pay rent, which is often cheaper than a mortgage on that same property, and you put your capital to work in a high-growth or high-yield suburb elsewhere. And guys, this isn't niche anymore. Recent data from Westpac's 2025 home ownership report dropped a bombshell. 54% of first-home buyers are now considering rentvesting. That is more than half. That figure has jumped 4% from just the previous year. When we break it down by state, the numbers are even wilder. In New South Wales, which makes sense, given Sydney prices, 61% of prospective buyers are looking at this strategy. Victoria is at 54%, and Queensland is right behind at 52%. We're seeing a cultural shift. The Australian Bureau of Statistics recorded 8,283 first-home buyer-investor loans in 2024 alone. That's a 12% increase year-on-year. Historically, investor loans for first-home buyers hovered around 6% of the total. But that sustained interest tells us that young Australians are rewriting the rulebook. They aren't waiting for the market to crash. They are adapting to it. Part 3. The financial mechanics. Why now? Okay, let's get into the weeds. Why does this make sense mathematically? There's been a lot of talk about the rent versus buy equation. For a long time, the argument was rent money is dead money. But in 2026, that old adage is being challenged by the sheer cost of debt. Research from UBank and Cotality gives us a fascinating snapshot. Nationally, median weekly rent values have surged by 39% over 5 years, hitting about $659 per week. That hurts, I know, but compare that to the median weekly mortgage payment, which stands at $922. That is a massive gap. In many premium suburbs, that gap is even wider. You might be able to rent a place for $1,000 a week that would cost you $2,500 a week to own. That difference? That is your investable surplus. However, the gap is narrowing in some areas, creating a unique window of opportunity. Here is a stat that blew my mind. In 7.7% of Australian suburbs, paying down a mortgage with a 20% deposit is actually more affordable than renting. And in nearly 1/5 of suburbs nationwide, the difference between the mortgage repayment and the rent is less than $100 per week. This is where the strategy gets exciting. If you can find those pockets, those suburbs where the cash flow makes sense, you can control an asset for a very low weekly holding cost. Part 4. The 2026 Economic Outlook. Now, we can't talk about property without talking about the puppet masters, the Reserve Bank of Australia. Where do we stand in 2026? Well, after 3 rate cuts in 2025, the RBA has held the cash rate steady at 3.6%. The major banks are forecasting rates to remain stable through the first half of this year. This is a departure from what we thought a year ago. Everyone was hoping for cuts. But this stability adds a layer of complexity. It means we can't bank on cheap money saving us. The numbers have to stack up now at 3.6%. Despite this, the growth engine is humming. NAB's quarterly survey projects capital city house prices to rise by another 6% over 2026, following a 3% growth in 2025. Domain is saying the same thing. Houses up 6%, units up 5%. So, if you're sitting on the sidelines waiting for prices to drop, don't hold your breath. The momentum is there. Part 5, the lifestyle factor. Let's step away from the spreadsheets for a second and talk about the human side of this. Why are young people actually doing this? It's about flexibility. We know that younger generations value experiences and lifestyle differently than previous generations. We don't want to be tied down to a 30-year mortgage in a suburb we hate just to say we own a home. Data from NAB and Ubank shows that 10% of younger Australians are explicitly willing to adopt rentvesting to buy their first home, more than any other age group. Here is the telling statistic. Less than 1/5 of 26 to 35-year-olds are prepared to live far from city centers. And under 1/7 of 18 to 35-year-olds would move further from work or family. They're drawing a line in the sand. They are saying, I will not sacrifice my daily happiness for homeownership. I will have both. Rentvesting preserves those lifestyle priorities. Part 6. How to pick a winner, strategy selection. So, you're sold on the idea. You want to rent where you live and buy where you invest. How do you choose where to buy? 2 primary approaches, and you need to decide which camp you fall into. Strategy A, the capital growth chaser. This strategy focuses on suburbs that are about to pop. You're looking for population growth, new infrastructure like a new train line or hospital, or economic transformation. The goal here is simple. You want the price of that house to double in 10 years so that equity can bridge the gap to buying your forever home later. Strategy B, the high-yield play. This prioritizes cash flow. You are targeting suburbs with strong rental returns, often in regional centers with big employers, hospitals, mines, universities, or places where housing supply is critically low. The goal here is to have the tenant pay off the mortgage for you. The most successful rentvestors often try to find the Goldilocks zone, a balance of reasonable yield and solid growth potential. Where are these spots? Well, look at the last 5 years. Brisbane property values surged 85.4%. Adelaide rose 79.1%. Those markets have been absolute rocket ships. Perth is also showing continued strength. But here's a contrarian thought for 2026. Don't sleep on the big giants. Melbourne and Sydney are seeing renewed momentum. Because they grew slower than Brisbane recently, their relative affordability, compared to their peaks, is creating opportunities again. Westpac found that 82% of Australians are open to purchasing in areas they hadn't originally considered. That open-mindedness is your superpower. You don't need to drive past your investment property. You just need it to perform. Part 7. The risks, the gotchas. I would be doing you a disservice if I just painted a rosy picture. Rentvesting is not a free lunch. There are sharp rocks under the water, and you need to know where they are. Challenge 1. The deposit barrier. This is the biggest hurdle. If you buy a home to live in, the government throws incentives at you. You can sometimes get in with a 5% deposit. But as an investor, banks usually want 20% up front. On a $600,000 property, that's the difference between needing $30,000 and needing $120,000. That higher barrier can delay your entry significantly. Challenge 2. Cash flow management. Investment properties, especially in major cities, often generate negative cash flow initially. That means the rent you collect won't fully cover the mortgage, the strata, the repairs, and the management fees. You have to top that up from your own salary. Yes, there are tax advantages. Negative gearing and depreciation can help improve your net return. But tax benefits are a refund at the end of the year. They don't help you pay the bills month to month. You need buffers. Challenge 3. Security of tenure. This is the psychological cost. You might own a portfolio of 3 houses, but where you sleep at night, you are still a tenant. If your landlord decides to sell, you're moving. You can't just hammer a nail in the wall or renovate the kitchen. You have to be okay with that trade-off. Challenge 4. The regulatory boogeyman. Keep an eye on APRA, the Australian Prudential Regulation Authority. They have signaled intentions to implement macroprudential controls because price growth is getting too hot. This could mean stricter lending rules, which might affect how much you can borrow. Part 8. The roadmap for success in 2026. So how do we execute this? If you're ready to pull the trigger, here is your checklist for making this strategy work in 2026. 1. Build a fortress of cash. Do not go into this living paycheck to paycheck. First-home buyer investors should maintain emergency funds covering at least 6 months of property expenses. If the hot water system blows up or your tenant moves out, you need to be able to sleep at night without financial distress. 2. Due diligence is non-negotiable. You cannot just buy a dartboard property. You need to understand local market dynamics. Look for the trifecta: transport links, established schools, and retail precincts. These are the things that make a property resilient during a downturn. Even if the market softens, people always want to be near a train station and a good school. 3. Define your exit strategy. Before you sign a contract, know how you're getting out. Is this a 5-year hold to build a deposit for a home? Is it a 20-year retirement play? Your exit strategy dictates what you buy. 4. Check your emotions at the door. Remember, this isn't your home. It doesn't matter if you like the bathroom tiles. It matters if the tenant likes them and if the numbers work. Conclusion, the verdict. So, as we look ahead through 2026, is rentvesting still viable? The verdict is a resounding yes. In fact, for many young professionals priced out of their preferred suburbs, it isn't just viable, it's the smartest move on the board. The fact that 54% of first-home buyers are considering it shows that the stigma of renting is vanishing. We are moving toward a European model of long-term renting, paired with an Australian obsession with property ownership, just not necessarily the property we live in. As median house prices continue their upward trajectory, with Sydney heading toward $1.83 million and Melbourne to $1.1 million, rentvesting offers a pragmatic pathway. It allows you to participate in Australia's wealth-building cornerstone without giving up the lifestyle that makes your 20s and 30s worth living. For aspiring investors in 2026, the question isn't whether rentvesting works. The math proves it does. The question is whether it aligns with your risk tolerance and your long-term goals. It requires discipline. It requires saving a bigger deposit. It requires handling the uncertainty of being a tenant. But if you can navigate those waters, it allows you to build equity in a market that is trying its hardest to lock you out. Thank you for tuning in, and see you next time.